So what the investment policy statement will do is will drive the asset allocation of your portfolio. The asset allocation of your portfolio is essentially which eggs are going to go into the basket. Now, the key is, an often misquoted study, is that asset allocation drives returns. This is not true. Asset allocation drives the variability of the returns that you can expect from your portfolio. So for example, if I've got 100% of my portfolio in the stock market and the stock market drops 20%, I can expect to have the same variability as the stock market. People like to believe that things that they can control, which are timing, going in and out of the market, or picking their best stocks in an entire market, actually drive the variance of the portfolio. 91.5% of the variance of the portfolio that you have, how much it will go up and down in a month, a day, or a year, is determined by getting the asset allocation right. So that's where we'll spend most of our time. Goals, your goals will drive your asset allocation. Your goals and your capacity and your tolerance for variability. One of the things I like to talk about sometimes in the practice, especially with regards to good money management, is what I call R&D, rob and duplicate. And one of the best places to look when it comes to long-term money management are large institutional pension plans, like, for example, the BC Investment Management Corporation. If you look at the investment asset allocation of a pension plan, first of all, its time horizon is in perpetuity. So it's got to be around forever. Secondly, it has to drive income and growth above inflation over an extended period of time for the people that are contributors. And three, they're public. So they have to tell us what's in their portfolios. So if you look at municipal pension plan managers like the BC Investment Management Corporation, they essentially run a balanced growth portfolio. What does that mean? It means that approximately 60% of the assets in that pension plan are going to be there for growth, and approximately 40% will be there for income. Now, if a pension is managing $211 billion of assets, and this is the asset allocation that they choose, it could be a good idea for us, with you as our retail investor and client, to emulate what that large scale pension does. We're talking about being balanced and having growth and income in a portfolio, but let's just go back to this idea, well, why wouldn't I just put all my money in cash? If I can make 5% in cash right now in a high interest savings account or a GIC, the real risk in the short term is zero. I know that next month I'm going to make 1/12 of that 5% as my return. But my longer term risk is the eroding buying capacity of that dollar if it's just sitting in cash. It won't keep up to inflation. The other issue is reinvestment risk. Eventually, when interest rates come down, that GIC or high interest savings account will produce a lower expected return. Rates of return on GICs and cash will not exceed the returns on a balanced diversified portfolio over longer periods of time. Remember, longer periods of time being 36 to 60 months, not one day, not 6 months, not 1 year. Cash can win in periods of time of up to 3 years. So what you can do is keep 10 to 20% of your operating account in a bank account for emergencies. You can keep money aside, say, for travel in retirement. So say you wanted to travel $15,000 a year in retirement, great travel fund. You might keep before your retirement 3 to 4 years of that travel bucket in cash. Say you needed to have money available for a major purchase. You might allocate a line of credit or 20 to 30,000 of short-term cash for those emergency needs. Cash is anything that you might need all the capital within the next 36 months. The rest of your allocation can go to your investment policy statement and towards a long-term portfolio.